Well, usually, I mean, the tendency is that we're likely to see a major breakout on this, and those tend to be very explosive. We may see a little bit of a digestion at the 50 level, but I think I wouldn't trade that. All I'm saying is wouldn't it shouldn't shock anybody if we see that.
No one realizes how important silver is and why they've been suppressing it for almost 50 years now, since 1980. Well, it's because silver is the money of the people, really. I mean, gold performs well, of course, and is doing very well, but it's more their money. It doesn't mean to say you shouldn't have any gold.
The breakout unfolding in silver is sending shockwaves through the precious metals market, marking what could be the most significant shift in decades. After years of frustration, false starts, and suppression dating back to 1980, silver has finally burst through critical resistance levels, confirming what many have anticipated for years. Charts are now flashing powerful signals. The gold-to-silver ratio has reversed. A rare teacup-and-handle formation is completing, and silver is set to close one of its strongest quarterly performances ever. History tells us that when silver leads gold, the bull market is entering its most explosive stage, and this time is no different. MarioInnecco, a veteran of London's financial world with over 2 decades of experience analyzing fiat and precious metals, emphasizes how this breakout reflects the inherent flaws of the monetary system itself. Alongside him, global macro strategist Tavi Costa underlines that this is not simply a technical rally, but part of a structural endgame in which fiat currencies lose credibility and tangible assets regain dominance. Mining stocks are already echoing the move, accelerating faster than the metals, a classic sign of institutional inflows and conviction. Investors are watching silver's $50 line in the sand. Once crossed and held, it could become a permanent new floor. This is not just about speculation, it is about protection, purchasing power, and wealth preservation in a system nearing its limits. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver price as a percentage of the gold price. It's the gold-silver ratio in reverse. And I spoke about this, or it was Michael Oliver who came on the channel about a month or maybe a little longer ago and said that we needed to break out above like 1.2, 1.3%. And then I've been tracking it, and I've spoken about it to you guys in the past few weeks. And this is a weekly chart, and now you can see that we're really breaking out here. I think when I spoke about silver a couple of weeks ago, we hadn't broken this trend line, and now it's just blown right through it. And so why is this important? Well, because since the 70s, when the dollar went rogue and became unbacked by anything, there's been bull markets in gold and silver. The 1970s bull market that peaked in 1980, and then the early 2000s or 2000s bull market that started in 2001 or thereabouts and peaked in 2011. Silver always lagged in the beginning, but towards the end of the bull market, silver led the way, and silver outperformed gold massively. And we've been waiting for this for the last 4 or 5 years. And every time it looks like silver is going to start outperforming, it doesn't. And then it kind of has kept gold a little bit under control, but not until I would say in the last year and a half. But we needed silver to confirm this, and I think what this will mean, of course, is that silver is gonna, and especially also the silver miners, they're gonna go crazy. It doesn't mean to say that gold is not gonna do well, but yeah, silver is gonna do a lot better. Does that mean I'm gonna sell my gold and buy silver? No, I just try to add on to both. In terms of the miners, I would say, yeah, have some. Yes, there is the danger of a great taking. You might be able to get your share certificates from your broker, even though that's becoming more and more difficult. You just need to, I would say, be aware of the risk and manage the risk yourself. I mean, the miners, to me, what I put into it was a small percentage of what I have in physical gold and silver. Now it's becoming a much bigger percentage. Yeah, there will be a time where I'll take profit on those miners, but I think it's still early days. So yeah, this is really important because it means that silver is going to take off relative to gold. This is what this chart is telling us. This is the teacup and handle formation, which I told you about. We're breaking out the end of the quarter. This is a quarterly chart. The end of the quarter, of course, is on Tuesday, and it looks like it's going to be the highest closing quarterly price for silver ever, and that's why I think the 50 level is very important, of course, because we got close to that level, 1980 and 2011. So it's the line in the sand. But if silver can stay above this line until Tuesday, and I think it could, there's a good chance, then look out above. And as I said, it's going to confirm the failing nature of our monetary system. Yes, I've been at this since 2002, not on YouTube, of course, because when I worked in the City of London in finance, I started looking at this fact that fiat would eventually die. And I guess I was over 20 years early, but I knew it would take time. But a lot of people, of course, always said, oh, we can keep increasing the debt, nothing ever happens. But I think right now we're at a point where it's the end game, as Rafi Faber would say. We are in Rafi Faber's end game. And yeah, you need to hold on to your gold and silver for dear life, as I've said many times. Yes, you can try to trade in the futures or ETFs, but that's a dangerous game. I think just holding on to your miners will go a long way, and even just holding physical is going to go a very long way. You shouldn't be greedy with this. I think there's plenty of gains to be made by holding physical. So yeah, this chart, what it tells me, this teacup, this is the price suppression that we've had since 1980. And it's now, the bullion banks in London and New York and Europe are losing control of it. What do we got here? Oh yeah, the dollar index, yes. It is kind of struggling to stay above this trend line. Yes, it could rally the dollar. Some people think if there is geopolitical event in Europe, the dollar could rise. And I don't think that would be negative for gold because look at the lowest level ever in 2008. And I remember exactly, it was in March 2008 when Bear Stearns had to be taken over by JP Morgan. And gold actually reached an all-time high of $1,000.32. 1,032. And the dollar index bottomed at 70.69. So ever since then, the dollar index has been going up, but gold has gone from $1,000 to almost 4,000. So gold and the dollar are not inversely related necessarily. So yeah, that's how I see the dollar index. I wouldn't really put too much importance on the dollar index because it's just measuring the dollar against other fiat currencies that are also collapsing versus gold. And we're going to look at that in a minute. So now I've got the Dow gold ratio, and that's telling me that there's trouble in the stock market as well. because after the bottom in April, the stock market has been rallying, and the Dow rallied against gold, but it formed a rising wedge, which is bearish, and we've broken below the trend line, and now the Dow is accelerating lower relative to gold. And eventually, I see this ratio, of course, going to at least 1-to-1 in the next few years. So let's continue. This is just a chart of the price of gold going back to the early 70s. It just goes to show you how we're still in the early stages of this breakout. Yes, last year I was looking at 2,700, which was around here. We blew through it, and then it retested it, and now it's gone back up above it. And yes, this chart is just very bullish.
The fundamental dynamic at play is the relationship between the US dollar and emerging markets. When the dollar rises, these economies are crushed under the weight of their dollar-denominated debt, unable to borrow in their own currencies, and forced into a cycle of dependency. However, the inverse is equally powerful. When the dollar weakens, these same markets experience a significant boost, with capital flowing in and asset prices rising. The early 2000s through 2011 serve as a perfect example, when dollar weakness translated into an 18-fold gain in Brazil's Ibovespa index, measured in dollar terms. That kind of asymmetric return is not based on politics or personalities, but simply on structural currency cycles. Just as investors once doubted that miners could ever be profitable, the current environment is reshaping those assumptions. With gold steadily rising, valuations are shifting, margins are expanding, especially with energy costs becoming a tailwind, and capital is rotating back into resource plays. This cycle is only beginning, and while corrections will come, they are opportunities, not threats. Staying positioned through volatility is what captures the generational upside. Let's get back to the interview.
I think the biggest thing you got to watch for is how much debt they have relative to their economy. And if you know that the U.S. government is being forced to devalue the dollar, okay, that's the key thing, right? This is why emerging markets get killed, is when the dollar is strengthening, they usually cannot really sustainably raise enough debt on their local currency markets because there's no appetite there, right? So imagine being a country that no one wants to invest in your country. And so when you're in that situation, the way you attract capital, you issue a bond in US dollar terms, so foreign denominated bond. And if the dollar goes up, your debt goes up. Well, that's not my view, right? My view is that the dollar is going to fall, right? So that's, it's the same thing as investing in a mining company, right? Why would I invest in a mining company if I have a view that gold prices will fall? I wouldn't, right? That's really not what I'm trying to do here. If I have a view that the underlying asset will go up, then think of emerging markets as almost like they produce dollars, right? It's the same thing as a mining company, right? But the difference, the difference here is that when dollar falls, it really, really benefits these countries. That's leverage on the dollar declining trend. And the fact that you can have that leverage at such cheap valuations, to me, is like, I don't need to bet the farm on this, right? Like, if I'm right about this, I'll give you an example, right? Because I'm from Brazil, and so I've looked at the Ibovespa index versus in dollar terms, not even in local currency terms. But if you got a movement in the dollar terms back in the early 2000s all the way to 2011, which was the last cycle, if you put a dollar there, you made $18. Okay, multiply that. All right, if you put $1 million, you made $18 million during that period. That's the most boring way of investing there. So I actually think there's plenty of ways to do much better than that. And the reason why I got into the mining industry is because I saw the same asymmetry, right? I was like, oh, I can put a few dollars and make multiples of my money. That sounds interesting. All I need is the gold price to start moving. And then the gold price starts moving. And everyone's saying, "Oh, the mining industry is broken. This is not going to happen." And then turns and everyone's like, "Oh, I told you so." No, you didn't tell me so. Like nobody said that. Everyone was, lost their minds and thought that structurally mining companies only bleed capital and they will never make money. And now all those people are starting to come back and say, well, should I revalue my views here? Maybe gold prices at $5,000, $6,000 do make these companies profitable. Duh. So, it's the same thing. Like, I think people are very stuck on the same idea on emerging markets, thinking that these things are led by, corrupt governments and so forth, but so is the US. And I'm not here to say that emerging markets will change structurally. Like, we're still going to have criminals running the place. We're still going to have, people like Lula running the country. I'm sorry, that's not going to change. That's not what I'm here for. Lula was running the country back in the early 2000s, exactly at that time when Ibovespa had its run of 18-fold, right? Not during the entire time, but most of it. And so, I don't know, does that really matter? Is that where you should be focused on? Is where investors usually get hung up on and the wrong stuff, So it's not a political play. It's a historic play on where the dollar is likely to go. And so, yeah, I just, it fascinates me how people get hung up on things that are not really meaningful. We saw the first wave where smart investors were in and institutional investors began to come in. And because of the size of the market, we saw a big jump. This is not ending here. This is the beginning. I feel very strong about this. Pullbacks need to be bought, in my opinion. And I would welcome them. I'm not going to, like, the way I invest in these cycles, the way I'm planning to invest in this cycle specifically, is that I'm not trying to be a hero in time corrections. I'm trying to take advantage of corrections. So when they happen, I'm going to buy more. And I'm hedging my position by owning as much as I can of energy companies right now, of which are breaking out as we speak. And it's very interesting because I think that that's also a very important trend taking place right now. And energy is important because it's the hedge you have on the margins of most of these companies, right? If you think about their margins is expanding drastically. First, prices are moving because people are projecting earnings. Now we're seeing realized earnings to the degree that we haven't seen in the past. And so as we see that sort of unfolding, I think as an investor, you need to think about your margins for those companies, and they usually link to energy. So think of the gold to silver ratio. The gold to oil ratio, the silver to oil ratio. Those things are very extreme right now. That's not to say that gold and silver are going to fall, but it's to say that oil needs a lot of catch up here, and that's another thing to consider.
The bigger picture here is unmistakable. We are witnessing the early chapters of a structural realignment in global markets. Precious metals, energy, and select emerging markets are positioning themselves as beneficiaries of weakening confidence in fiat currencies and mounting debt burdens across developed economies. This isn't about chasing short-term moves, but about recognizing the long-term cycles that are now unfolding. The lessons of the 1970s and early 2000s are resurfacing, and those who stay disciplined through volatility stand to gain the most. For investors, the challenge is not in identifying opportunity, it's in having the patience and conviction to hold it. Gold, silver, miners, and energy all point toward the same outcome, a system under stress and capital searching for safety. Those who prepare today could define their financial resilience for decades to come. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.